Hi, and welcome back to Accounting 482. This is session 39 and 40. So, this will wrap up Module 4, and we'll discuss a little bit about wrapping up the entire class at the end of the video. But this is it, guys. I want to first thank you for taking my class and working hard. This is a challenging class, and this will be the last time I come to you, but let's make it fun. So now we were talking about making business decisions, and we're looking at capital investment decisions, and we're looking at methods of comparison. So we've learned a few of the methods, and now we're going to continue that and finish those up. So I always got to click it. Always got to click it. So this is an in-class quiz, but we're just going to go ahead and do this assignment because I really think that it's a good one. Okay. So O'Malley's purchased an asset for $90,000. Annual operating cash inflows are expected to be $20,000 each year for the next 6 years. No salvage value is expected. And assuming O'Malley's cost of capital is 16%, that's huge. Wow, that is fantastic. What is the asset's net present value? So let's go back to our notes page. And I need to, first we'll do the in-class quiz so we know what we're doing. And then I will make a chart, table, I should say. It's a table. Okay. And we'll need year. And we'll need a revenue. And we'll need expenses. And we'll do 0, 1, 2, 3, 4, 5, and 6. And in the first year, they purchased the equipment. Was it equipment? Asset? What do we got here? An asset. They purchased an asset for $90,000. Purchase. And the revenues are $20,000 every year. Whoops. We'll do our little copy and paste. You know, I bet. Boom. Oh, that didn't work. I figured for sure that would. Nope, that didn't do it. I figured for sure that would give us 20,000 down there every time. But we're going to have to do the old copy and paste. And we'll just do that because that works. Okay. So that's what we have. And then I'm going to do another chart. Table. I know. I never have the wording right. The dollar value, the present value factor from the tables, and then the present value. Because we want to see if this is a good investment. So they purchased the asset, and the value was $90,000. And this is 1 because they did purchase it today, so the present value of that is 1. And then the revenues. and they are $20,000. Didn't like that. Okay. And the present value would be, you know, 6 periods at 16%. So our factor would be 3.685. And the present value of all of those payments is 73,700. So the net present value of that added together is 16,300 negative. Okay, this is a negative. And it's a no-go. So the terminology when you're figuring out these, comparing these different methods, is go or no go. And that's what you'll hear in a business rules. You know, oh, is that project a go? Not yet. Not yet. Is it a go? No, not yet. Is it a go? No, it's a no go. We're going to lose money. Okay. So that is common. Okay, let's move on to the next one. Now, we're going to compare projects using net present value. Again, remember net present value takes into all the consideration of the outflows, the inflows, the tax. That's why you call it the net present value. So if you have sufficient funds, then you accept all projects with a positive net present value. But remember, cash is a limited resource. So, you know, everybody has, even though you think your company has a lot of money, their accountants are saying, no, you don't have a lot of money. You only have this much money, especially, you know, when it's a big company and there's lots of different departments all wanting to start projects. So you have to pick and choose which ones you want to do. So you need to, if you have limited funds or the company isn't going to give every project a go, you need to accept the project with the highest net present value, or you need to accept the project with the highest project profitability index, PPI, project profitability index. And the PPI, unlike net present value, adjusts the return for the amount of the initial investment. So net present value just gives you the net present value of your outflows and inflows and adjustment for taxes. The PPI, project profitability index, takes into consideration your initial investment, which will gives you a different number. So comparing projects using net present value and PPI, Clean Cars is trying to decide whether to remodel an old car wash or remove it entirely and install a new one. Now this is something that is relevant for your car wash company. You know, do you fix up the old one, spend a little money, fix up the old one, or do you just, you know, raise it and create a whole new one? And if the company uses a discount rate of 10%, discount rate again is your amount that you could get on other investments. If you put that money into other investments, you could earn 10%. What would the company do using net present value and PPI? So we're going to look at both of these, and we're going to do net present value, and we're going to do PPI for both of them. The new car wash costs $300,000, and it has a salvage value of $7,000 in 10 years. And we need we'll need new brushes at the end of 6 years for $50,000, and it will generate $90,000 in revenues and $30,000 in expenses each year. So let's go to our notes, and we'll do, what one is this? Example 4. And we're going to do a chart. Wow, whoa. A table. We'll insert a table. We're going to do a 4 by 10. Let's see if that fits. Perfect. And I think we should be able to make that work. So, first of all, let's do some... first, we have the interest rate of 10%. We want to have that information up there so we know. And this is the new car wash. The new car wash. And we've got the year, we have the revenue, we have the expenses, and over here we have the explanation, info. We'll just put info. Okay, so year 0, and 1, 2, 3, 4, 5, 6, 7, oh no, 8. Looks like we're going to have to add 2 more rows. Oh, good. I was afraid it was going to bump it. I might have to make it'll bump. Oh, shoot. Let's just bump it down so we don't run out of room. Ah, okay. There we go. Because I'm going to have to make it bigger. Okay, so in year 0, the expenses are $300,000 for the new car wash, and this is the purchase of the new car wash. Car quash? No, wash. Okay, new car wash. And in year 2, you also have $20,000. Where did that come from? Let's take a look. Oh, the old car wash has a current salvage value of $20,000. So you would add that to the new car wash. I should have kept reading all my information. Okay. So you're going to get that back. So if you raise the old building and that scrap, whatever you can sell, it's going to net you $20,000. So it's revenue in year 1. And actually, it's not in year 1. We're going to delete that. It's revenue in year 0 because you spend this $300,000, you get the $20,000 back. And then in year 1, you get $90,000. So we're going to copy and paste that. Whoops, don't do that. I bet somebody's going, hey, just click enter or something. That will be faster, but I can't quite hear you. So I'm just going to do what I know. All right. And then the expenses are $30,000 a year. Okay. And hi, I'm back. Okay, so these are $30,000 expenses every year. Oh, I want the little. Let's get all of it. All right. Nope. I thought the enter would work, but nope. Okay. Now we have one more thing in here. We had the replacing the brushes in year 7. So we have a $50,000 outflow. And that is to replace the brushes. Okay. So here is our setup of inflows and outflows. And it really is easiest to do this that way you can see it. And this is the old car wash. Let's see. Okay, good. Okay. This here is the old car wash. Okay. And we need another table. 3 by 12. Nope. This way. Okay. My phone's in the way. All right. So again, we have the year and the revenue. I don't know why I keep putting a D in there. It's not in there, but and the expenses. Okay, so again, we'll have your 0 and 1, 2, 3, 4, 5, 6, 7, 8, 9, and 10. And there's no revenue in this one. Let's go back to the PowerPoint just so we're sure. Has a current salvage value of $20,000, which we took care of with the new car wash. Would cost $175,000 to remodel, and has an estimated salvage value of 0 in 10 years, so we don't have to worry about that. Will need its brushes replaced at the end of 6 years for $80,000. I think I put it on year 7 last time. I'm going to have to change it. And will generate $70,000 in revenues and $25,000 in expenses each year. What did I do up here? Oh, yeah, not cool. We're going to have to just put this up here and say $50,000. I got to double check here. Of course, I could go back to the PowerPoint. Yes, $50,000. On year 6, because that changes everything, right? With the factor. Yeah. So this one for the old car wash, you'll have to remodel it for $175,000. And in year 1, your revenue will be $70,000. And so we just want to copy and paste that all the way down. I know there's probably a faster way, and I wish you were in the room and say, "Hey, Shelley, do that," and it'll work. And I'm like, okay, I would totally do it. Okay, and now $25,000 expenses every year. So we're going to copy and paste that. All the way down. Okay. And then at the end of year 6, we'll have $80,000. $80,000 in replacing the brushes. Okay. And now, so here's we have our charts laid out here, and we're going to go on to this next page. And now for part 1, we need to calculate, let's move it up so we can see here. Calculate the net present value of the new car wash. And so we can do a nice fancy chart. Let's do a chart. I need a 4x6. Okay. So here we have cash flows. We need the dollar value, the present value factor from the tables, and then the present value of that amount. So the cash flows, we've got the purchasing, the equipment, and the value of the new car wash is $300,000. The present value factor is 1, right? 1, because we're definitely going to do that. And so it is, again, $300,000. And then we have the salvage of the old car wash. And that is $20,000. And the factor there is 1, because we'll get that right away. So the present value of that is 1. And then we need the net annual inflows, which is the 90,000 minus the $30,000. And that is $60,000. And the present value factor, if you look it up at 10%, 10 years, 6.145. So the present value of all of those payments is $368,700. And to replace the brushes is a $50,000 cash outflow. And since this is a present value of a lump sum in year 6 at 10%, our factor is 0.564, and it is a negative 28,200. And then the salvage value of 7,000, and that would be at the 10 years, 10%. Our factor is 0.386, which puts that salvage value in today's value, the present value of 2,702. So then we add all those up, and we get a net present value of 63,202. And this is just adding up all of those. So that's our net present value for the new car wash. Now, we want to, part 2 is to calculate the net present value of the old car wash. So let's get us a chart, a table, and we'll want cash flows and dollar value and the present value factor and the present value, so that we can add up all of these. Oops, I bumped my My speaker, that probably hurt your ears. Okay, purchasing the equipment is $175,000. Present value factor is 1. So the present value of that outflow is 175. And then the net annual inflows. And going back up to our basic information, we have $70,000 revenue, $25,000 in expenses. That's going to give us a net annual inflow of $45,000. And our present value factor here is the same as it was on the last one, right? 10 years, 10%. It would be different if we had different set time, a different N or a different percent, but we don't. 6.145. So our net value of our cash inflows is 276,525. And then we want to look at the replacing the brushes. And this example is $80,000 outflow. And we do it at the same time, so we can use the 0.564 because it's happening again in year 6 and it's still 10%. So our present value of doing those brushes, 45,120. So the net present value of the old car wash is equal to $56,405. So looking at, we'll just go new car wash so we can get them in the same general area here. Great. The new car wash, the present value is higher than the present value of the old car wash by about for $7,000, about $7,000. Now let's take a look at the PPI. And the new, I guess I probably don't need this bold. The new machine, you have to look at the cost of the net present value, right? Net present value, and that's 63,202. And then you want to divide it by the initial investment, which is $280,000 up here. $280,000 because we are taking this purchase price and we got the salvage value, so it's actually 280 and not 300,000. 280. So 63,202 divided by 280 is going to give us a PPI of 0.226 or 22.6%. So looking at the old car wash, it's going to bump me down. So we'll just do it now so it doesn't bump me down in the middle. The old machine, net present value, machine, net present value is 56,405. And the old machine cost is 175, because here's our outflow, initial investment right there. So 56,405 divided by 175 is going to give us a PPI of 0.322 or 32.2%. Okay. So you can see, if you were looking at net present value, getting the new car wash would be the better deal, because you're making more money on that. But if you look at the initial investment as part of the equation, the old machine gives you a higher percentage of return on your money. So it the PPI, and it will depend on what your manager uses seriously. Some managers will use net present value. Some managers will use PPI. It just depends on what they want, and your manager will, depending on which one your manager likes, you need to know how to do them both. So that's why we went over those right now. So now we have just a couple more things to do here. Now we're going to look at the IRR, internal rate of return method. First, we need to determine the company's hurdle rate. And the hurdle rate is, again, a different term for discount rate, rate of return, internal rate of return is different. Your hurdle rate is the amount of interest that you can earn on your investments. And now the hurdle rate might be 10%, it might be 8%. So it's just what the company, and again, it's internal, well, I shouldn't say that. It's just what the company can earn on their money. So all of their investments, they want them to be at that hurdle rate. They want over that amount for their investments, because that's the lowest that they can earn on their money. So then we need to find the average profit for each year of the project. And step 3 is to set up the following equation, which is current cost equals to the average profit per year multiplied by the present value of annuity factor and the IRR percent. And then we need to solve for the IRR. We need to compare the IRR of the project with the company's hurdle rate. If the IRR, internal rate of return, is greater than the hurdle rate, we can accept the project, because we want to make sure that this project is going to return us the same amount of money or higher that we can make on any of our other investments. So example 5, the IRR method. Jane Doe Small Bakery has been offered the chance to move into a store in the mall for the next 5 years. She estimates that the move will cost her almost $119,750 with remodeling and other fees. The result of the move will be an increase of $40,000 worth of revenues and $10,000 of expenses each year. Currently, Jane has 3 loans outstanding: a $150,000 6% loan, a $50,000 8% loan, and a $95,000 9% note. Okay, so what is Jane's minimum hurdle rate? So let's figure that out first. Jane's hurdle rate. Okay, so we need a chart. So we'll just call this step 1. And we'll get our little chart going. I need a 3x5. So we need to find the debt, the interest rate, and the interest payment. So she's got those 3 loans. She's got a $150,000 loan, and the interest rate on that loan is 6%. And if you do the math, the interest payment is $9,000 a year. The second loan is a $50,000 loan, and that interest rate is 8%. So our interest on that loan is $4,000. The very last, it's a note, $95,000 note, is at 9%. And the interest rate on that is $8,550. So our total outstanding loans is at $95,000, and our total interest is $21,550. $21,550. And so her cost of capital is your money, how much you are borrowing. So the cost of borrowing that money is $21,550, and you divide that by the total amount, $295,000. So her hurdle rate is 7.31%. That's her hurdle rate. If she can earn more money, if her internal rate of return is a higher percentage than 7.31%, then it's a good investment, because she's making sure that she can pay this interest payment on more of a debt. Okay, so step 2 is to calculate the average profit. And our revenues were I don't know why I'm trying to put a D in there, but I've been stuck on that all day, right? $40,000. And our expenses are $10,000. So our average profit is $30,000. So that's our average. Okay. So now we have our hurdle rate, we have our average profit. So we're just getting all the pieces together here. Step 3, whoa, not bold. We need to set up the equation. So that's the current cost is equal to the average profit per year multiplied by the present value of the annuity factor and IRR, internal rate of return. Okay, so our current cost is $119,750, and our average is $30,000 multiplied by, I do not know why I have that in parentheses. I shouldn't. So we're going to take them out. $30,000 and the present value of an annuity. And we have for 5 years, and we don't know the percentage. Okay. We do not know the percentage. So to just dividing 119,750 by 30,000, we get 3.992 is our present value of the annuity, 5%. And when you divide that by 5, you're going to get 8% is our IRR. So yes, it is higher than our hurdle rate. It's higher than our hurdle rate, so we will do it. Okay, so if we go back to the PowerPoint slide, it says using the minimum hurdle rate, should Jane move to the mall? Yes. What if Jane wants her hurdle rate to be 1.5% higher than her cost of capital? So, keep going here. So, if her hurdle rate is 7.31, but she wants to add 1.5%, that's going to give her 8.81%. And businesses do this. They want even more money than, they think that the work and the moving and the expenses aren't going to be worth it if you just come above your hurdle rate. They want 1.5% more. So if it's an 8% IRR, then if you have 8.81%, no, with the extra hurdle, it is not cost effective to move. So there you go. Just depends on what the manager or the owner wants. And when you're the owner of a company, you can do that. Okay. So another in-class quiz. This one's pretty good. Big Al's is considering the purchase of a new equipment costing $15,000. They expect the new equipment to give them annual cash savings of $3,000 for the next 6 years. Assuming that Big Al's normally makes 8% on his investment, should he buy the new equipment? So let's go back to our document, and this is in-class quiz. So the new equipment is $15,000 for Al, and his IRR is 8%. So $15,000 divided by $3,000, which is the savings that they're going to get, is, oh, I did not do that right. I jumped ahead of the game here. $3,000 this should have the parentheses because it's an outflow. This should not. Multiplied by the present value of an annuity, 6, and the percentage. We don't know that yet. So 15,000 divided by 3,000 is going to equal 5. So that's your percentage. This is between 5 and 6%. You just take the 5%. No. It's not close to the IRR, to the internal rate of return. So it's not a good investment. Okay, so we won't do that. Okay. now. So net present value versus IRR. So uh, the pros of net present value is generally considered easier to use. You just figure out what your costs are, your outflows and your inflows, and you get your present value factors in there and you multiply them out and just add them up. And it's easier to adjust for risk because you know how long you want to have the project and what your interest rate is. It provides more useful information and it doesn't make the assumptions that all cash flows are nice, simple annuities. You can adjust those inflows if you have, you know, different you figure you're going to make a certain amount in year one, but a different amount in year two and a different amount in year three. It's all easy to do the math and get those to the net present or to the present value, and then just add them all up and get the net present value. So the cons of net present value is it requires the extra step to compare projects in most cases, like calculating the PPI, and net present value is often harder to explain, although most managers are going to know how to do that. But if you're trying to explain it to another engineer or another employee, it might be a little more difficult. So what? And of course, that's Jason's thing. I would say, well, what does this mean? But he likes that. So that's what we're going to go with. So capital investment decisions focus on long-term investments. This makes them more crucial to the company than the tactical decisions that we discussed in the last chapter. So if you mess up, you're going to be locked into that project for a long time and you're going to lose the company money and they're not going to be very happy with you and you might get demoted or removed from your job and you have a long commitment to repay the financing. So if you talk your company into doing a project that's not doing well, then they're losing money and they have to pay for that project. Yikes, that's not a good thing. So then you can not only make a lot of money over a long period of time with these decisions, but you're also in a position for you to have additional expansion or other opportunities over time. So these decisions really help you if you build another factory. You can really expand your business and there's other opportunities because if you expand your business into one area, maybe you can expand again in another area. So you hope that these long-term projects really go well. These are the decisions that are made by owners and senior managers and by the consultants they hire to help them. So you, as a first year manager, you're probably not going to make these these long-term decisions, capital investment decisions. You're probably going to be doing more of the tactical decisions. But knowing what they are and understanding them will help your company reach their goals. And there are also decisions that most need to be verified by auditors, potential investors, and and having a good understanding of these principles is crucial for external decision makers as well. So if you're looking at a company to purchase stocks from this company or even to work for a company, if you know these capital investment decisions and understand them, that will give you an upper edge on buying stocks or whether you want to work for a company long term. Those kind of decisions, right? So this wraps up making business decisions. We talked about tactical decision making. We also talked about capital investment decisions, time value, and methods of comparison. And we did that. So that we're going to go full circle now and take a look at the entire semester and what we accomplished in this class. First, the first module was tracking costs. Did we know how much your product costs? No. So then we learned basic terms, calculating cost per unit, and using cost information. We learned how to do that. So once we learned how to do that, then we could go into budgeting. And do you have a master budget? No, we created a master budget and then we used the master budget. We created pro forma financial statements and we used that budget to make good decisions on how to change prices or help investors understand our business or actually just make decisions on different types of scenarios. And once we learned how to do that, then we analyzed our performance. We took our budget, what we budgeted, and what actually happened, and we compared those. And we ended up doing variance analysis, CVP analysis, and financial analysis on our performance. And this can go down as far as employee performance. We didn't talk about this in this class, but you can take a look at each manager and see how well they performed according to their budget. Did they come in? Did they have good ethical decisions? And that's about were there variances? Were there variance analysis small variances or were they huge? Did they try to, fluff the budget so that they could get bonuses? And then after we analyzed our performance, then we used we went into making business decisions. So we needed to make our decision, and if we can't make our decision, we had to break that down into tactical decisions and capital investment decisions. So we did all of that. We started with tracking costs, and now we're making tactical and capital investment decisions. And you can do this. You can use the information that you learned in this class in a business that you work for or running your own business. And that's what enterprise accounting is all about. So what we learned in this class is how to create various accounting tools for making business decisions. We learned how to use those tools effectively for making business decisions. And then again, this is Jason, but to appreciate accounting more than you do now, I just think that it is crucial to understand accounting and understand how to do these tools and understand the numbers, because every business decision comes down to the numbers. It quantitative, they talk about qualitative, aspects of business, but it always comes down to the quantitative numbers. Always, always, always. So, this is going to wrap up the class. It's going to wrap up everything, and I appreciate you taking my class, and I've enjoyed having you and getting to know each and every one of you. Thanks again, and we'll see you, not next time, maybe in another class. Thanks again.